to another episode of the IBC Guys. I'm Dave. Looking at myself on the screen here because we record this on YouTube as well. I look very unprofessional. I got a sweatshirt and a hat on. That's how we roll here at the IBC Guys. So thank you for joining me. I think I got a cool episode. Got some good feedback on the last couple, just kind of talking through outsiders' perspectives on IBC. So we're going to kind of carry that theme with a little different caveat from the onset. But yeah, excited to share with you. So I had a couple meetings with Mike today, talk with him. There's no shot I was getting him on a podcast today. It is hunting season, shotgun season there in Minnesota. So that gentleman is spending hours sitting in a blind. He told me he saw 30 deer last night and didn't shoot a single one because they were not good enough. So if you ever want to know a deer snob, you know Mike Stevens. So I'd be blasting away at anyone that came across. Hopefully it had horns on it, but not him. So he probably has 30 to 35 hanging in his house. And that doesn't count all the other animals as well. I don't know if he wants me sharing this. I'll share it. They got a giant moose hanging in their house. Every Christmas they put a Santa hat on them. That's my kid's favorite thing. But anyway, I'm digressing. I got a cool episode. Excited to share it with you. But going through kind of the intro stuff, the IBC guys exist for three reasons. First is to get information about IBC out there. I think we're going to accomplish that today. Kind of maybe a cautionary tale as well. We want you to understand what IBC is, what you'd be getting into if you potentially pursued something. We want you to be as knowledgeable as you can be to make the best decision you can for your family. 100%, that's the goal. So if we were to quantify these, that's the main goal. I want people to do that. But two is to provide actionable, implementable examples. I don't know if we're going to accomplish that a whole bunch today. We're going to talk more on the opinion theory side rather than the actionable side. But that is the second goal. We certainly have done that in other podcasts. But the third goal is to get it out to as many people as we can. So today, if you know a NASCAR fan, this may be one that you can share with them because we're going to talk about Kyle Busch today. If you're familiar with Kyle Busch, NASCAR famous racer, we'll discuss him. But I have an email, dave@familybakingSolutions.com. Maybe you've forgotten who Mike Stevens is at this point. Who can forget Mike Stevens? But he's got an email, mike@familybakingSolutions.com. He's very active in all this. He's just not doing podcasts. Like I said, I had meetings with him this morning. We talked to a couple people, and he helped give advice and strategize, and we did that together. And I enjoy that man. I got to pin him down for a podcast. So again, email him. Tell him he needs to jump back on. We got to get him out of that deer blind and back on the podcast. We do have a phone number, 507-205-2284 if you want to call in. Either Mike and I will answer that. It's a phone call. If you text us, either Mike and I will text you back. So you'll get one of us. All the other socials and stuff are in the show notes. If that what flies your kite the highest. Can't say we check Instagram a whole bunch, but there's stuff up there. So you're welcome to try and contact us there. All right. Context to today. I know all of you, I'm sure, are following all the life insurance news that exists around the nation. That's me being facetious. But one of the things that has come out recently is Kyle Busch and his wife are suing Pacific Life, the insurance company. Their agent, I don't know who it is. I don't know their name, but got them into some permanent policies. We're not whole life. They were IUL, so the Index Universal Life. And they were promised, the growth of cash value. But as that policy kind of grew over the last several years, I think if I remember correctly, they established it in 2020. We're talking a giant policy, like $1.5 million a year, had a death benefit of like 44.5 million, if my numbers are correct. Just giant policies. And again, the whole goal, and you can leverage. So pause here a second. IBC can be leveraged through countless. Shouldn't say countless because that makes it sound like it's infinite, but through a myriad of different vehicles. You can do it through an IUL. You can do it. I have a buddy that's kind of leveraging it through a self-directed Roth IRA. They're accessing money, and so I don't know all the ins and outs of that. I am not security licensed, and certainly not giving advice in any of that. So I'm not your expert there. But IBC in and of itself is not a whole life policy. IBC is a concept of becoming your own bank. And as Nash and his buddies, Carlos Lara and Dr. Bob Murphy, went through and did all their research and their work, it has been licensed, or excuse me, not licensed, verified and proven that whole life policies are the best vehicle to run these things through for all the benefits that they provide. So Mike has told me stories where people come to him and say, this does it better. And they sit down and they work through the numbers. And every time, Mike has said, the whole life, wins out. So if you have an idea of something that could be better, I'd certainly listen to it. And then I would say, hey, let's talk with Mike. And I would get his perspective because he's much more knowledgeable in those areas than I am. But back to Kyle Busch. So their agent set them up with these giant policies in an index universal life policy. So again, it's a permanent policy. Essentially what the difference is there's no contractual guarantees like there is in a whole life policy. So if you're familiar with an index universal life, there's also a variable universal life, which is even more, let's call it risky. Again, depends on your risk tolerance if you want to use that definition. But an IUL, essentially, it leverages term insurance, and then it takes the money and it invests it in indexes. So again, I'm not a security person, so you could probably come back and say, well, you said this right, you said this wrong. I'm just going to tell you the best I can. But like the S&P 500, different indexes and things like that is how the cash value is set up to grow. But again, you can leverage the cash value. You can go use it. There's more flexibility. There's still a MEC limit that exists in these things. So I think that's correct. Again, don't quote me on that. But there's certainly more volatility in these things. There are years where you will not make any money. So I just looked at an IUL the other day. I think the past 10 years, there's always this is what will get you a percentage, and this is what we'd like to get you percentage. But over the last 10 years, there were special, like, I guess 2008 was in the last 10 years. So maybe it was 20 years, 25 years. I don't remember. But I distinctly remember 2008 didn't make anybody any money. I think that makes sense because of the stock market crash. There was not a lot going on with people making money in 2008. So 0% was made. So there's no contractual guarantees in any of those. But the promise on the non-guaranteed side is much greater than a whole life policy. So it's kind of the rabbit and the hare situation. So the goal of this podcast is not to get into what an IUL is. I have never written an IUL. I try and stay away from them because the contractual side, the guaranteed side of the whole life policies are much more reliable and consistent, obviously, if there's a contractual guarantee. So we stay in our lane that way when I write policies with people. But Kyle Busch and his agent got into an IUL. And as from 2020 on, as Kyle, I think, learned and maybe saw the performance and maybe the agent, there's a lot of maintenance that goes into IULs. I don't know what the agent, if they were doing their job and maintaining that. But Kyle was not happy and didn't feel like the promises that were communicated to him were being fulfilled. So at this point, they have sued Pacific Life to try and get their money back. They feel that they have lost. So I give you that context. You can go read it. I'll put a link in here. But what it led me to is a cool blog. It's a website, essentially, of a guy. Get back to it. Got it on my screen. His name's Bobby Samuelson. And I was reading through Bobby's kind of reaction to this Kyle Busch situation. And Bobby struck me as very, very knowledgeable. So I started digging into his website a little bit. It's called lifeproductreview.com. So I'm not endorsing Bobby. I don't know a whole lot about him. Over the last couple of days, I've kind of worked through his website. And what has kind of stuck out to me is he tries to be as unbiased as he can be as he reviews different products. So he'll take a product and is very knowledgeable, specifically in IUL, and he'll talk through the ins and outs, the goods and the bads. And he gave his reaction. So again, the reason I got to Bobby Samuelson was through Kyle Busch. And Kyle, he gives a great, in my opinion, a great kind of summary and his reaction to the Kyle Busch situation. It's very, it may be above, it was above my head a little bit. And I talk about this stuff every day. Again, I'm not in the IUL world. And this was an IUL that was sold, but I probably tend to understand a little bit more. He's very, very knowledgeable, smart man, um, knows what he's talking about. But he gave a very unbiased, got graphs in it, but an unbiased look at why he thought and why he would have known had he looked at these policies that the agent, had done Kyle dirty. So the agent, I'm sure, is going to go to court and say, here's why I did what I did. I did it with best intentions. Kyle's going to say, here's why I don't think you did. And the court's going to decide who's correct. But again, that's how I got on Bobby Samuelson. So, with kind of the last couple episodes we have done, I think it's a natural thought progression to go, well, what does Bobby think of infinite banking leveraging a whole life policy? I think it's a fair question. This guy seems to be as unbiased as possible. We tried to do that last week with ChatGPT. ChatGPT not being in person, hopefully it's as unbiased as we can get as well. But I would argue this Bobby Samuelson has a much better working knowledge than even ChatGPT of how to articulate the goods, bads, the ins and outs of whole life. So my goal in this podcast is just to kind of talk through what he had to say. Again, just to put it out there, so rather than you having to go read the article, I'll try and summarize it, and then I'll put in the show notes access to it as well. You're welcome to go take a look. So Bobby did an entire, got to get to my thing here, an entire blog post about this whole life or IBC leveraging whole life. He also did a podcast on another podcast, so I think he has his own. I didn't listen to that one, but he was talking with another gentleman that talks IBC. That gentleman was not as keen on IBC. Would say don't do it. So I kind of listened to that, and I took that conversation and I kind of put it Bobby's reaction into a document and kind of want to take you all through that. So again, that's the goal. So looking through my notes here, he says IBC is a specifically designed participating whole life insurance policy that's used as a personal bank from which you can borrow and repay yourself. So if you listen to enough of these episodes, if this is your first one, you may want to go back and listen to some other ones. I think it's a pretty accurate synopsis of what we try to describe IBC as on this podcast. It's a specially designed participating whole life insurance policy that's used as a personal bank from which you can borrow and repay yourself. Infinite banking. So some of the benefits that he says exist in this strategy. So there's more control over your capital rather than relying on traditional banks. So I talked with a gentleman today, and we were talking about their 401k and the limits you can put in, can't touch it till you're 59 and a half. The question kind of came up, how can you use your 401k to buy your next car? And it's like, that's kind of a dumb question. Well, I know it's a dumb question. I was trying to bring up a point that you don't have clue. You don't have control, liquidity, and usage of your money, CLU. That kind of hit home with this individual. And, Bobby articulates this as one of the benefits. You have more control of your capital rather than relying on traditional banks. So I went to a 401k, which is a qualified plan. That's not a bank. So you could argue, well, banks give you more control. Absolutely. But then you can get into, well, in IBC, you are making the money the banks would make off of, and you still have the control over your capital, the clue, the control, usage, and liquidity of those of your money. So that's a benefit that Bobby came up with. Another benefit is access to cash value in the policy to finance things when needed. So there's no taxable events in there, but you have the cash value available. So let's say you're going to go buy a car, or you want to take your wife on vacation, or like me, you're going to pay for your daughter's dance team for the year. Take that out, go use it. It's there to be used. I would encourage you to do it if I were your agent. It's not a great investment to just sit there. Again, I'm not qualified or licensed to talk about investments as defined in the greater capacity of money, but there are quicker ways, better ways to make more money faster. IBC, the goal is to monetize money you're going to go spend anyway. So let's say you're going to go invest, put the money in an IBC policy and then go invest. So you have your money, make money, make money. I had someone ask me that today. Clarify that for me. So maybe we'll do that here in a little bit. What I mean by have your money, make money, make money. He told me that was very confusing. So I'll talk about that in a second. But you have access to cash value in the policy to finance things when needed. So that is a benefit of IBC. Again, that statement right there, one could very easily argue that's what a savings account does. That's true. How much you making on your savings account? And when you access the money from your savings account, let's say you have $1,000 in there, you take $500 out, you only have $5,000 in your savings account. In IBC, when you leverage the cash value and go use it, $500, you still have $1,000 in there, making you a guaranteed internal rate of return. So there's a big difference between a savings account and IBC. That statement in of itself, though, I could see how one could argue that semantically they do the exact same thing. But jumping in context, the third one he gave, again, you got to put the whole context together. But the third benefit that Bobby gave is the dual nature of the whole life insurance. So there's a death benefit and the cash value accumulation. So we talked last week about the other side of IBC is how I titled it. So I don't think it gets talked about often enough. The life insurance side of the vehicle we use to run IBC through, so which is a whole life policy. So my policy, when I die, it's not if, it's when, that death benefit then goes out to my family members, my beneficiaries, whoever it may be at that point in time. And again, that can change, and you can, as the owner, do what you want with that. But there's the death benefit side as well as the banking side. He termed it cash value accumulation. I would argue it's more than just the accumulation. It's the use of that money. Leverage the cash value, put the money back in. It works like a savings account, but that money never leaves the ledger. You're just borrowing against the money using the death benefit as the collateral, and you go do with it what you were going to anyway, and just keep funneling your money in and out to capture all of that. And that there's no subtraction sign on that ledger. So the more money you funnel through that over the course of the years, again, not a quick it's not a get rich quick scheme. Easy for me to say. But as you do that, that exponential growth is going to go very, very quickly over the course of time. So you have both exponential growth and uninterrupted exponential growth and time on your side if you start these things soon enough. So the best time to start them is yesterday. So again, let's go through the three things that he identified. There's more control of your capital. You have access to the cash value to finance things when you need to, and the dual nature of what you're doing with the death benefit and the cash value accumulation, or what I would say is the banking side. So the drawbacks and limitations. This is probably what more people are interested in, because I'm biased. I think IBC is great. What are the drawbacks and limitations according to Bobby Samuelson? So the high costs and fees is the first thing that he talked about. So I can understand how this comes up. Certainly not going to say there's not high costs and fees, but I kind of want to put some context, some anecdotal context around that. I have spoken with people that they went to an agent from a big company, and that company said, you don't have enough money to start a policy. Come back to me when you have blank, this threshold. And that is a complete farce. There's no minimum amount. There's a minimum product amount. You have to have at least $25,000 of death benefit, but that's not hard to do. I mean, couple $100, maybe even a year. It depends on the person. How young are they? How old are they? You have to have at least $25,000 in face value death benefit. So there's not a high cost that exists there. A lot of times agents, it's like maybe a realtor taking on a parcel of land. Again, we own a land company. There's land out there that's worth $1,000. Realtor's not going to touch that. The commission, 6% commission on $1,000, $60. They're not going to spend, weeks trying to sell this and trying to find a buyer for $60. They're not going to touch it. So a lot of insurance agents won't touch smaller policies because in their minds, it's not worth the time. That's not why Mike and I exist. And that's not why we're trying to do this. We want to just get IBC in people's hands. So let's do the small ones. Mike would argue, and I think he said it many times, those are his favorite ones. So he's got two boys in college. His favorite policies to write are those of of their teammates. These guys, they get $100 here or there. Maybe they get some NIL money, name, image, and likeness money from playing college sports. Let's run those through policies. Those are his favorite. And Mike makes, $80 or $60 to use the same example as the realtor. So there's not a high cost to the policy itself. Another side thing that I have experienced is I've had agents charge clients or potential clients to just sit down with them. They'll say, my time, we'll schedule an hour. Sure, I'll talk through IBC with you. It's going to cost you $300. I can understand the high cost to that. That's not something Mike and I do, but I have had that done. In terms of fees, there are fees associated with it if you're paying like monthly, like it's $8 a charge or something like that for the processing fee. I don't know where the high cost and fees comes in. So he didn't explain that. It just was a blanket statement as I was listening. He could be speaking to like if you were to do your policy, the 60-40 split, you only have access to 60% of your cash value that first year. And your dividends, the cost of starting your policy, the dividends are not very big the first probably 3 years, I would argue. So that could be what what he could be talking to in terms of the high cost of fees. He'd have to elaborate a little bit more. But it's kind of like starting a franchise. There's costs up front, but if you can stick it out, you have the discipline. It's hard to argue the financial benefits that exist in year 10, year 15, year 20. So certainly not for the faint of heart. You have to have some financial discipline to do this well. But that could be what he's speaking to the high cost of fees. So again, a blanket statement. They didn't really go into, again, the guy interviewing him loved that because he jumped all over it. They didn't expand on it other than saying, yeah, I agree, it costs a lot. And maybe they did compare it a little bit to term, the cost of term. But again, the cost of term is for a certain amount of time. And the last percentage I knew, 98 I think it was 8%, 98.5%. There you go. Jeez Louise. 98.5% of term policies do not pay out. Do not. So once you do that, so let's say you do a 20-year term, I'm 42. When I'm 62, I'd have to apply again. Who knows where my health is? But my policy, it's probably going to cost me $7,000 a year to get a term policy for $1 million. Whereas when I'm 42, it could be $600 a year. So term certainly has its drawbacks, but they did compare the cost to those. I think Dave Ramsey does the same thing when he talks about life insurance, if you're familiar with Dave Ramsey. So I understand that, but the whole context is not there when those discussions are had. The next one's the complexity. You need planning, discipline, understanding, and understanding of policy loans in the long-term horizon. Couldn't agree more with that. That is a drawback. One, it's not taught. You're not learning this in your financial literacy class in high school. Two, there's not a lot of people that want to take the time to do it well. That's certainly a desire of Mike and I's to sit down and do it well. And by do it, I mean explain it well. We would much rather you understand it and decide no than to just say yes and not understand it. I have witnessed Mike say, this person was ready to go. Let's do it. And Mike has said, no, we're not ready there. Your understanding is not where it needs to be. We're going to pump the brakes a little bit, and we're going to make sure you understand it. Make sure it's still something you want to do. Again, he runs, I don't know how many businesses, a bunch. We have our land business. That's what supports our family. So the commission isn't necessarily a motivator. There is a commission that comes to us. It's directly from the insurance agency. We don't collect a single dime from any client that has ever come through our desks. But again, just make sure I'm fully transparent. We do get a commission. That commission, again, depends on how much money the policy, or the client is putting through their policy. So if they're putting $1 million a year through it, which I have never had that, be kind of cool. There's certainly a greater commission that exists in $1 million policy than $100 a month policy. So that all depends. So there's no one set number or anything like that. And I think most people understand that. But going back to the drawbacks, the complexity of this, a lot of people need to know the how. And I completely agree with that. Being a former math teacher, I would always ask my kids, why are we doing this? And they would roll their eyes and, give me some cockamamie answer about how I'm mean and, just high school stuff. But I needed them to know why we were doing it. It wasn't just to make their lives miserable. This is the reason we're doing it. And I would argue the same thing needs to be understood for IBC. Why do these policies work? What are you looking to do with this? How does it fit in with what your family wants to accomplish in the future? So there's certainly complexity that exists there. Call it a drawback or limitation. My hope is that we can help advocate that to be a positive rather than negative. There's complexity there. That's okay. We just want you to understand it before you make any decision moving forward. It works. I promise you it does. We're in the 4th year of ours. My wife and I sat down and budget stuff today, and we're starting to get to that tipping point where we put money in, and I can take more money out than I put in. So I'll put $10,000 in. Let's say this year I get to take $11,000 out. I make $1,000 as soon. So 10%, excuse me, 10% growth right from the onset. And it only gets bigger the older the policy gets as I continue to fund those premiums. So it is complex. 100% agree with that. He calls that a drawback. I can understand that argument. I don't necessarily look at it as a drawback, because Mike and I are working to make sure people are educated. So if you give us that opportunity, we'd love to sit down with you. All right, the third drawback he put on here, it might not be the optimal approach for everyone, especially if your goal is aggressive growth or you don't have the patience to do it. 100% agree with this one as well. This is not an investment. IBC is not an investment. I think we've said that a million times on here. I'm not licensed in securities. I'm not licensed in that stuff. I'm not a certified financial planner. I am none of those things. This is not a good investment. You could easily go take your money, put it somewhere else, and make money faster. What I can guarantee is that IBC is contractual, uninterrupted growth. And if you are patient and play the long game, and again, he calls that a drawback here, it takes patience. But if you have the discipline and patience for the long game, that contractual, it's a contract, that contractual, uninterrupted exponential growth in 15, 20 years is going to be greater than anything you can do outside, especially with the volatility that exists right now. Who knows what's going to happen with the stock market? I don't know what your view on politics are. I'm certainly not going to share mine here, but I think there's a lot of unrest and unease in the economy, in the stock market. I know we hit an all-time high the other day. I understand that. I'm in the land business that kind of correlates to the housing side of things. Certainly not directly, but I get a lot of that in there. But I personally am seeing a lot of 2008 coming out in what we're seeing, and that was not a great year for everybody in terms of finances. So I'll have to say, contractual growth, this is guaranteed. It's a contract that's signed. But part of that, I just got on that tangent. Part of that though is you put your money in there and then you can go use it. It's not a put your money in and forget it. That's not the goal. Put your money in, get that contractual growth going, and then go use it for where you want it to anyway. So if you're going to go invest it, go do that. If you want to pay your house insurance off or use it towards your mortgage or buy a boat, you can do all those things, but you have your money on the ledger making you an internal rate of return, a guaranteed contractual internal rate of return. So you're having your money make money in the IBC, and then you can go have it make money somewhere else. So that's the have your money make money mentality. So again, the 3 drawbacks he lists were the high costs and fees, the complexity of it, and then it might not be the optimal approach if your goal is aggressive growth or you don't have the patience for the financial longevity of it. So I agree with those for the most part. Not really the high costs and fees that have to clarify, but the only fee by definition I can think of again is like if you're paying monthly, there's processing fees, and you don't get to use the entirety of your cash value from the onset. Um, that's all I can think of. So he does say it's not a magic solution. How it's beneficial depends heavily on your individual circumstances. I would agree with that. So IBC is not will it work for me? It's how. It definitely will, but it certainly fits people differently. And I think that's what he's trying to get at. And I would agree with that wholeheartedly. He does go into clarifying. I want to clarify some misconceptions about it. Again, this gentleman Bobby, he tries to come at it from an unbiased perspective, and I think he does a pretty good job. Again, go check him out. But some misconceptions he says. He says borrowing your policy doesn't mean it's free money. Interest still applies, and your policy's performance and structure matter. 100% agree with that. So you can borrow against your cash value. And the idea that you're making money, that money never leaves the ledger, you're making money. It does cost you interest to borrow that money, but often your money is making more money than it costs you in interest. So you could argue that you're still making your money. There's drag on your policy, is what I like to call it. So you're not making as much money as you could, but you're still going to go leverage that money and use it how you were anyway. But the longevity idea is, let's say you put $10,000 in every year, $10,000 the first year. Now I have $20,000 the second year, and I've gone and used my money each year to pay my taxes, my federal and state taxes. Great. Third year, I'm saving up taxes, putting it in my policy. I have $30,000 in the ledger. Cost me, $8,000 to go pay my taxes. I pay that, and then I keep saving, keep paying back. But as that ledger grows, because there's no subtraction sign, after 10 years, you got $100,000 making you a guaranteed contractual internal rate of return, even though you've gone and paid your taxes. So it certainly is not free money. I think that's a lot of detractors' biggest point. You're paying to borrow from yourself. That's stupid. Well, following just that singular statement, I would agree with that. But the context, the fact of your money's growing uninterrupted, there's no subtraction sign from that ledger. And the fact that you get to leverage that cash value and go do with what you want anyway is a benefit. It's not a detraction. So that is a misconception. I agree that exists. It's not free money. But the context needs to be there. And again, that's the goal of what we're trying to accomplish here. Another misconception, it's not simply about buying whole life and then you're done. So he kind of like buying whole life and then you're done. I was doing air quotes if you're listening. He put the policy must be structured appropriately with the right funding and used in a disciplined way. 100% agree with that as well. I would not encourage you to just let's use $10,000, put $10,000 in the policy, buying whole life, and then just let it sit there. That is not the goal. The goal is to leverage and use the money. Take it out, go spend it, pay it back. The next year, put another 10,000 in, take it out, go buy some land like me, hunt on it for a little while, sell it for more than you bought it for, refund your policy, but not you that entire time you've had $20,000 making you the internal rate of return, the contractual internal rate of return. So it certainly is not buying whole life and then being done. If that's your plan and how to use this, I would recommend doing something different with your money. So again, misconception, he says that exists out there. Third misconception, the strategy is often sold with hype, and some of that hype glosses over the costs and the risks. I'm not a hype guy. Pretty boring dude. I like to hang out with my wife, play with my kids, and go play golf. So I don't have a lot of hype in me. I don't do this as a full-time job. I jump on and do these podcasts because I want this for people. I genuinely believe it's life-changing, again, with the patience and the perseverance of financial discipline. But I don't know if I'm a hype guy. Maybe you feel otherwise. That's your opinion, and you may feel that way. I know Mike is definitely not a hype guy. He would much rather be in the deer blind, um, hunting on his farm than doing podcasts. So all that's again with his businesses, he doesn't need to do this either. He's just been doing this for a long time, thousands of policies at this point. You just want to help people. So hopefully you don't see the hype. Um, and we certainly don't want to gloss over costs and risks. So if we ever get a chance to talk with you, we would lay out this is your cost. Again, we don't take a dime from the client. We do get a commission from the insurance company. That's out there. Um, it's nice. It's not our motivation, but no other costs and fees. The risks. This is about as least risky as you can get. Now, he could be speaking to like an IUL, and again, the Kyle Busch situation. There's a lot of risk that exists in IUL compared to a whole life policy, and even more risk if you're doing like a variable universal life. That's uber risky. So there's risk that exists there. I wouldn't say there's a whole lot of risk as long as it's a properly structured whole life policy, which is only what we write. So again, another misconception, um, but I think a very well stated one in terms of his behalf there. So he provides some guidance at the end for someone considering IBC. So I'll just read him off here. He encourages people to understand how it fits with your entire financial plan. 100% agree with that. How to work with someone who understands the details. Hopefully that's Mike and I. If you don't want to work with us, again, I think I've shared on here already. I was working with a person and they're like, do you have someone else you can introduce me to? Great. I kind of hurt my feelings a little bit. I don't know, but it's not about Dave. It's not about me. And I introduced them to someone else, and they did a policy. That is, I would much rather that happen than Dave, you know, feel like he's the man. I would much rather pass that person off, have them feel comfortable with someone, have them get their questions answered in a way that's understandable, and then make the decision about IBC. So work with someone who understands the details is another uh, point of guidance from Bobby. The next one is to make sure you commit for a long period. So again, this is not a short-term play. It is a long-term play. But he also says in that you won't be forced to pull out early or let the policy lapse. Um, I guess life would be the one that forces you to pull out. So when you're the owner, the agent has nothing to do with any of that. So um, again, he didn't elaborate on how someone would be forced to pull out early. You can have the policy lapse if you're not paying your premiums. So we'll talk about that. How long you have, if you get a chance to talk with me, how long that would take, what those premiums would look like, and things like that. But make sure you commit for a long time that you won't be forced to pull out early or let the policy lapse. And the fourth point of guidance Bobby gives is compare the opportunity costs. What else could you do with the money? Great thought. So we did a podcast episode on the economic value added. What would that look like? But I do think something Bobby missed here is that it's not mutually exclusive. It's not IBC or something else. It's IBC and that's something else. Run your money through there and then go get your floors done in your house. Do both of them, but the money you spend on your floors will remain on the ledger, making you dividends and interest while you have borrowed against your cash value with your death benefit as the collateral and gone and done your floors as you would have anyway. So I think it's not a full point he's making, but to compare the opportunity cost, what else could you do with the money is a very valid, fair point. So that's great. So he did key takeaways. He did these. I'm going to read them real quick. I always go longer than I mean to. So if you're listening and you're thinking Dave's going, I'm sorry, I'm going. But he did some key takeaways. So if you have stable, sufficient income, if you are patient and you want more control over how you access and use capital, IBC may be a good fit for you. It's a very fair statement. I think that's well stated. The next key point he has, if you're more focused on short-term gains, high growth, and are uncomfortable with the policy complexity, IBC may not be for you. He also goes on and says another vehicle may make more sense, IUL. The numbers on IULs look bigger than they do in a whole life policy. The reason I don't work with IULs is because there's no contractual guarantee. There's no guaranteed numbers that exist there. It's all hypothetical. So as soon as that illustration is provided and that policy is signed in force, the next day that illustration looks different because of the volatility of those indexes, specifically, how those indexes are organized, stock market, things like that. So there is some more risk that exists there, but the short-term gains potentially are greater. So if you're into that, you want that high growth, that quick return, IBC may not be for you. But again, he's I think, missing the point in that you can do both. Put your money in an IBC policy and then go invest in an index. You can do both of those things. So why not do both? This is kind of my question. Implementation. So the next key takeaway, implementation matters greatly. So the structure of the policy is very important. You got to understand the loan mechanics and you got to remain disciplined and monitor the policy over time. 100% agree. We're trying to accomplish that proactively in this podcast. We don't get to everything. It's hard to get everyone's questions answered in 40 minutes a week. That's where a phone call or an email to set up a time to talk would come in. And we'd love to do that with you. The next key takeaway is beware of the quote unquote sales pitch version of IBC that glosses over costs, assume you will always win, and promises unrealistic returns. Again, that's the non-guaranteed side. I can show you contractually in an illustration what your policy will do. So it's not a matter of speculation. This is the guaranteed look at it. I'm never going to try and sell you. I'm not a salesperson. I'm not good at it. I don't know. My only promise is that won't be the case. So I agree with the key takeaway, though. Be careful of that. Working with someone that felt like they were not heard. They got a policy, they signed on the dotted line. It's in force. But as we've had discussions, this person and I, it's kind of come to light that they didn't really get heard. They don't feel heard. So I would hate for you to fall into that. I want you to know everything before you make a decision. Maybe that's not realistic. As much as you feel comfortable, have a solid working knowledge, and then go and make a decision for your family about IBC. But again, beware the sales pitch. I think that's great. A great takeaway. The last key takeaway, as with many financial strategies, no one size fits all. Use it if it aligns with your strategy and don't view it as automatic. It's a good takeaway. It can fit within your financial strategy. That's where Mike and I have the most fun, I would say, is working out how it does. But I've had plenty of people say it's just not for me. That's cool. It really genuinely is. As long as I feel as though, and again, it's not about Dave, but from my perspective, as long as I feel as though you understand it and you make the decision not to do it, I'm a happy camper. I feel like I've done my job. I feel like tend to be a person of faith. I feel like what God has asked me to do. And I can lay my head on the pillow at night and sleep really well. So it is not for everybody, and that's okay. But I do feel like it can fit everybody if that's something you and your family want to pursue. So again, Bobby Samuelson, check him out. I'll put some links in there. If you want to read about Kyle Busch, I'll link the specific review he did on Kyle Busch's situation. If you're not into life insurance, which I have to be, I wouldn't say I'm into life insurance. I have to be with what we're doing. It gets a little maybe monotonous in its minutia. But it's a good read and it talks through why he thinks what he thinks, and it's very, very thorough. So check out his other stuff. Again, I'm not advocating for Bobby Samuelson. From what I have read and looked at, he does a good job at looking at products unbiasedly. So if that's of interest to you, feel free to check him out. Again, I'll link it in the show notes. So thanks for listening. If you would, email us, DaveFamilyBankingSolutions.com, Mike at FamilyBankingSolutions.com. You're welcome to give us a phone call. Just be happy to talk with you. would be excited to do so. It's fun to meet new people, hear their stories. There's a lot of cool people out there, and I'm sure that you're one of them. And I'd consider it an honor to meet you if that's something we can make happen. So give us a shout, shoot us an email. But first and foremost, thanks for listening today. Hopefully you found it relatively interesting and helpful. So again, go check out Bobby Samuelson, see what he has to say. But overall, keep learning about IBC, and if we can help in any way, we would love to do that. All right, we'll catch you next time.